Hello, I wanted to hop on. I've had several clients send me different news articles talking about the government or the Biden administration making loans more expensive for good credit and loans for that are riskier, cheaper. While this is true, the headlines can be a little misleading, so I just wanted to give you kind of a behind the scenes look of what's happening. First of all these articles talk about it going into effect May 1st. While that is true, again, it's been in effect for all 30 plus of our lenders since early April, because not only does a home buyer need to close their loan, but the lender would also have to sell their loan to Fannie Mae or Freddie Mac, government-sponsored entities, by May 1st in order to avoid the new changes. So let's do a quick dive on what this actually looks like as far as the different credit scores. So when we price a loan, different credit scores, different down payments, everyone gets different rates. So I'll give you an example of what's going to be changing. Shout out to Mortgage News Daily who put this chart together or stole it from someone else. Basically what this means is there are certain buckets that did get more expensive and there are certain buckets that got cheaper. Now this doesn't mean, so I'll give you an example. 740 score with an 85 loan to value. This basically means 85 loan to value, which means 15% down of the purchase price. That got 0.75% more in fees for that rate. So that's not 0.75 in a rate. That means if you're getting a $100,000 loan, just to make math easy, every single rate option got $750 more expensive. For most lenders' rate sheets, that means maybe 0.125 or 0.25 in an interest rate difference. Now, I get where these articles are coming from because they are all showing, hey, look at these greens. You have someone with a 620 credit score only putting 3% down. How come their rate got so much better? And it did, but to be honest with you, I've never closed a loan with less than 5% down under 640 credit score on conventional. Now these loans, FHA, VA, all that kind of stuff all day, but on conventional, these aren't super realistic. Now, again, we're all upset because no one wants to tell someone that, yeah, your rate's going to be 0.125 or 0.25 and you have a 740 score. There's a lot of things that haven't changed or barely changed. For example, if you had perfect credit, 780, you get a better rate compared to a month ago if the market didn't change, if you're putting less than 5% down, but that doesn't mean overall you are getting a better rate comparatively. So I'll give you some examples just so everyone can see what I'm talking about. So these are three examples here. 10% down with a 760 score. Second column's APR. This is on a $700,000 purchase. So if you're at a 6.25, costing you $4,400. If you happen to be putting 3% down, 720 credit score, it's about $5,600. And then if you're a first-time home buyer, and you're under the median income for that area, now I'll explain that's a very important change, that's actually cheaper. But that's something that happened last year. So some of these fees that we're talking about here may be helping pay for first-time home buyers special rates if you make under the median income. So this came out last October. If you're a first-time home buyer, which means you haven't owned a home in the last 3 years, and you make less than that median income in that area. So a few markets we work in, Phoenix, number one, if you make less than $88,800, or even if you make more, but we're only using your salary, for example, and your overtime pushes you over, you will qualify for the best rate possible on conventional. A couple other markets we work in, the Atlanta area, it's about $95,000. Denver, because they're high cost, they can actually go even higher. It's about $141,000. And then you have markets like Miami where it's not as realistic because the median income is like $77,000, but the prices are still quite a bit higher there. So anyone that is a first-time home buyer, doesn't matter if you're putting 3, 5, 10% down, you are getting your best rates. And that's why someone at 6.25, it's only costing $598 in fees compared to if you were just a non-first-time home buyer, if you were making more than that. But comparing these two, yes, the person putting more down with a better score is still getting a better deal than someone with a 3% down and 720 score. The gap just narrowed a bit in that case. With that being said, I do think you're going to have more 3% down buyers using FHA. So I priced this out earlier. Someone was making 6 figures. They happened to be a first-time home buyer, but they couldn't qualify for this because they were over the income limit. I think it was a 700 or 720 score. They had 5% to put down, but they were still getting a slightly better deal on FHA because FHA rates are lower than conventional. And this happened a couple months ago. FHA is a true government loan, and they did drop their mortgage insurance. Now, FHA loan limits are lower, so you can't buy quite as big of a home. But going back to this chart, I don't think you're going to see a lot of these. I don't think you're going to see quite as many 3% down conventional buyers. There'll still be plenty, but not quite as many because FHA got considerably cheaper literally in the last month or two. So again, this is definitely not changing the industry by any means. You know, depending on where you're at, your rate might have gotten 0.125 better or worse. Now, if you're a first-time home buyer under the median income limit, or if you're going with an FHA loan, that did get considerably better. But if you don't fall in those categories, nothing crazy different. So just wanted to share this. You know, some people got a little worse, some people got a little better. Thanks for watching.